Hey guys, welcome to the How I Raised It podcast, the show where you get an inside, unfiltered look at how real entrepreneurs raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with Jonathan Hollis of Mountside Ventures, a London-based consultancy that helps European startups raise capital. We talk about getting an investor ready, building the target investor list, key terms on a term sheet, and much more. If you're tuning into this podcast to learn how to raise capital for your business, I've created a super valuable free welcome package for you. It includes a list of 2,500 investors who don't require a warm intro, plus 200 questions that investors are going to ask you. So this is going to really help you get ready to raise capital. To get instant access to this, click the link in the first comment. And while you're there, please leave us a nice comment, what you enjoy about this show or this series in general. And last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy the chat with Jonathan.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite.com. Today I have Jonathan Hollis of Mountside Ventures coming to us from London area. How's your day going?
Great, thank you. How are you, Nathan?
Pretty good, pretty good. What's happening in London these days? How's the scene?
It's getting better. I say that, the UK is getting a few more COVID cases recently, but generally people are out and about and back to normal client meetings and investor meetings, especially across London.
That's beautiful. Yeah, we just took our team, Foundersuite team, to Austin, Texas for South by Southwest last week. And
nice.
It's the first time.
How was that?
It's so much fun. It's so exciting, but they've canceled the last two years. So it's been 3 years since we've done this. And it's exciting to just be back face to face with people, talking, listening to music, meeting people, connecting, all that good stuff. So it feels good.
Yeah, I bet. I saw quite a lot of buzz on it on social.
It's a thing. It's a thing. If you get the opportunity, you should make it out. It's pretty impressive. All these companies, startups and larger companies alike, have events, parties, showcases, booths, setups. It's pretty cool. It's kind of like, I kind of like call it like Burning Man for tech companies. Everyone has their little camp and you wander around, and it's fun. It's neat. Well, let's jump into what you guys are doing. What is Mountside Ventures?
So we launched about 2 years ago with a mission of optimizing the fundraising process for funds and founders. So at a kind of a core level, we partner with founders looking to raise capital, typically late C to Series B, and act as an extension of their team as an interim CFO. So we might get involved in supporting building out the financial model, the pitch deck, supporting them, taking them out to market, and then ultimately helping them get funds that with terms that are right for them. And then the other side of the business also works with emerging fund managers across Europe. And we produce content, run reports, and also have a yearly conference where we invite a whole bunch of family officers and limited partners, who are the organizations that invest into VCs, to an event. And so what we're trying to do effectively is, on the VC side, get more capital from LPs into those funds, and then ultimately bring that capital down to the founders.
Interesting. And startups used to do a little work like that years ago. I had a firm called Venture Archetypes that was helping companies. So I'm familiar with that model. But in the UK, you're in the UK. In the US, you've got to be a broker dealer. What's the business model? Do you have to be a broker dealer or an agent to do what you do, or how does that work?
So I think the short answer is yes. We are regulated, but I think other advisors we see in the market are not. And I think it's just a question of they're small and not too worried about the risks. But given that we're a bunch of chartered accountants, we wanted to do things properly. And so we got regulated because in the UK, the act of introducing an investor to a startup is regulated, and the act of providing advice to a company is also regulated. And so we are, but the majority of people that work in this space are not. Their risk to bear.
Got it. And so, startups, I get asked all the time, hey, I don't want to raise money. This is too painful. It takes too much time. Do you know someone who can do it for me? I mean, are you literally like a done for them type of service, or is it more coaching, advisory, nudging the founders along the right path? How much of it is like hands-off versus guidance?
Yeah, good question. Because investors of all shapes and sizes want to deal directly with founders, and so often we take a step back and we help them behind the scene, because a fundraise can take anything between 6 to 9 months for most founders, and therefore as a result of that, it's a big time drain, and so we try to support them by understanding the market, mapping the investors, understanding what needs to make sure from an investor readiness perspective, helping them with the model. Especially in the UK, in Europe, the financial model is a critical part of the fundraising process. Whereas I know that in the US, the investors are less worried about the traction, the financials, and that side of things, and they're much more concerned with the vision and the team. And that's one of the differences we see between Europe and US. But generally, it's about equipping the founders with the tools they need, understanding what the investor readiness process looks like, supporting them through those documents, and then really trying to save time in not meeting hundreds of investors that simply either don't have the cash to deploy, or there isn't a fit. And we collect a lot of information from investors to really understand which type of funds might be relevant for which founders. Because ultimately, even if a founder hires a CFO that specifically looks at that fundraising process, or even the founder does it themselves, it's impossible to know at any given time the list of all the new funds that have just been announced. Building a relationship from over the last 6 to 9 months to actually build that momentum and those touch points, it's very difficult. And that's one of the key pain points that we solve. But absolutely, in answer to your question, no, that the founder needs to be front and center throughout the raise, but they can rely on us to support in the background.
Let's break it into a few pieces. Let's talk about investor readiness. You mentioned that. I think that's interesting. So what does it mean for a startup to be investor ready? How do you know when a startup is ready to go raise capital? I think this is a common question. So yeah, what's your take?
Yeah, it is. And I think being investor ready has got two angles. The first angle is the documentation aspect, which, at a very basic level, an MVP, as you could say, is the pitch deck, the financial model generally. And then the third key document that we work with our founders to build is the investor FAQ, and list of
the what
10
FAQ.
The investor FAQ, yeah, it's a list of 10 to 12 most common questions asked by the investor. The founder just has to be able to nail from day one. Sure. So from a documentation perspective, that's your investor documentation MVP. Then you've got the data room, the cap table, and other aspects. But those are the three key documents that companies really need to have before they start a proper institutional round. And then on the other side of investor readiness is, I guess, the stage the company's at. So that's around what key hires does it need to make, and what does the existing team structure look like. And then, of course, the magic question is around revenue and traction, especially in Europe. Different stages require different thresholds, and therefore there's no point raising a larger institutional round if you haven't hit some of those key metrics, which differ across investors, and they also differ across industry. In Europe, especially, if you're a B2B company raising a Series A, the 1 million ARR figure is always used as a bit of a benchmark. If you're raising a Series B, the 5 million ARR figure is used as a benchmark. And of course, in different sectors, that figure might be higher or lower. So if you're a deep tech company, or if you're a healthcare company, the 1 million might be a much softer benchmark, and most investors for an A round might actually look at companies that are producing revenue a lot less than that. Whereas if you're a consumer brand company, that 1 million typically is a lot, is an absolute minimum. And if you're raising a Series A, most investors want to see at least 2 million of revenue for that first institutional check. So those are the two pillars, the documentation, but also where the business is at and whether it's ready to go for funds.
Getting into a little bit of the weeds here, I don't want to get too deep, but a couple of quick questions on the model. I mean, pitch deck, that makes sense. I like that investor FAQ. I think that's smart to prepare that in advance so the founder's ready. On the model, are we talking about just a revenue forecast? Are you talking about statement of cash flows or balance sheet? Like what goes into the model? Just what's the short
So
answer?
it's very detailed. Typically, it's a 5-year financial model on a monthly basis, including ideally the last 2 or 3 or more years of actuals. And so you've got your 2 years of actuals and then your 5-year forecast. And you would expect a P&L, a balance sheet, and a cash flow that all reconciles. An MVP financial model for us is your P&L, a clear set of assumptions, a dashboard with the optional of balance sheet in there as well. But the assumptions to have in the dashboard really is what the investor would look at. Your dashboard being the main P&L across the years and across the line items, and the assumptions is one of the most critical tabs on the model, and is also the one that most founders we see have about 15 different tabs along the bottom. But really, a one-tab assumption is the most important aspect. Why? Because as an investor, I can go in and go, what happens if my growth doesn't double year on year? What happens if it takes 6 months instead of 3 months for my new sales hires to actually be able to be productive and bring in those new customers? What happens if my customer numbers fall? And so these are the set of sensitivities that an investor would like to do.
Sure. Do you think, in your experience, do the investors, and maybe it's different in UK, do they really go in and poke at these, or is it kind of a checkbox on their side, from the investor side, right? They just want to see
So it depends on the type of investors. Definitely the UK scene has a lot of ex-consultants, ex-bankers, ex-accountant as part of the investment team, and that's just a function of the ecosystem. And as a result of that, a lot of the investors, we work with the early stage. If you're an ex-consultant or an ex-accountant, you're absolutely going to go to those levers and see what happens. In a doomsday scenario. Even some of our fastest growing companies that we've worked with and partnered with, who have closed their funding rounds. Just last month, one investor said, "Great, I like the model. Now, can you please produce a doomsday scenario?
Mm-hmm.
What happens if most of your customers don't renew? You can't find new customers. What does your cash flow position look like?" The other month, another investor asked us, "Actually, I understand the model, but what happens if you're able to raise a much lower amount rather than the 5 mil that you suggested?" So then you have to think, okay, what happens if I'm raising 2 million instead of 5, and how does that how does that relate to how I'm building the business? So in our experience, absolutely, many do, and the way that we advise companies is that, of course, there's investors that don't look at the model. Of course, there's investors that see it as a box ticking exercise. But our advice to founders is always please the median investor, because fundraising is so difficult that if you're making it harder for those picky investors that like to use their levers, then you're just removing the number of volume of conversations you could be having. So yes, even if a third of investors don't like the model at all, you don't want to remove the possibility of speaking to the other 2/3 that actually are quite interested into it. And so we always see it as please the median investor and to maximize the number of potential conversations you can have.
One more quick question on that, and then we'll shift to a different topic. One of the debates when I was doing the consulting, and again, this is several years ago, but whether we should send the actual spreadsheet to the investor so they could have their analyst or associate from Stanford or whatever poke into it, or whether we just send them like a PDF kind of summary of our financials. And there's pros and cons to both sides. What do you kind of recommend folks do?
We absolutely need to send them the full download. I think, especially in the UK, I think many companies will probably be laughed at by investors if they send them just the PDF version. It's a bit like, we do a lot of work with LPs and family officers who invest in VC funds, and their big bugbear is, they get PDFs from their VC funds, and then it's very difficult to actually plug in what the portfolio looks like into their own database to track those funds. It's the same kind of thing for VCs. Most VCs aren't data hoarders. They love downloading pitch decks, adding it to their CRM. They love downloading financial models, and the easier you make their lives, the easier you find the process. And so, of course, there's exceptions. One exception they think could be if you're getting 15 term sheets at once in the same month, and you're the hottest deal of the week, and all these investors are throwing term sheets at you. Of course, you sit back and go, I'm only going to share what I want. But that's only 1% of the 10 to 20% who are able to raise successful funding. So you're talking about, 0.1 to 0.5% of entrepreneurs. And, clearly when we're talking, I'm talking about what advice would apply to the majority of founders rather than those a very small portion or exceptions.
I think the concern when I was doing this was that if you give the investors the full model, they're going to find the weaknesses. They're going to use that to kind of negotiate or use that as leverage to either hammer down your valuation or, hammer better terms. Like almost you're giving them too much ammo. But I guess
you are giving them ammo. But as long as your model's robust and it's big vision and you've got, sensible year 5 numbers on there, if most companies are looking, I don't know, year 5 basis, anything from 20 to a couple of 100 million revenue, right? And if you're a top tier founder and you're looking to take over the world within your sector, if you've got a couple of 100 mil revenue in your year 5, the worst they can do is chop some of that revenue off. But if you're raising a sensible valuation now, you've still got a large growth potential there. So I think as long as the model is well constructed, sure, it doesn't matter if they rip it to pieces, because ultimately, all founders we speak to have no idea what they're doing tomorrow, let alone in 5 years' time. And so there's obviously a sense that the model is there simply to show the vision and the growth drivers, and so it's there to be updated and to be discussed. And the number of times that founders say, actually, we've got investment from an investor, we're super happy, and they sat us down on day one and they ripped apart the model and say, right, what's actually going to happen now? Let's start this 100-day plan and let's actually get sensible, reasonable assumptions. And so there's an aspect of they know it's a bit of a game, but they also want to see how founders think where the value will become from the model.
Totally. That's what I used to tell founders. Like, every investor knows your model is BS, but it's the assumptions and how you're thinking about it, and how you're planning to spend money, where you're putting the money you're raising to work, all that good stuff. They want to understand.
Exactly.
You get that. Okay, look, we could talk about that for another half hour, but let's shift gears a little bit. In terms of, investor readiness, you help these companies get ready. Now, kind of in the next phase of what I assume is identifying the right investors, what advice do you have? I think this is a hard thing too. Like, even with our platform, shameless plug, we have a database of 200,000 investors, but it's still hard to build like that really good list of like your perfect match investors. So what advice do you have for founders to do that?
I think the advice for clients we work with, often it's a case of we can leverage those relationships that we have with those funds. And as I mentioned earlier in the introduction, as well as supporting founders, we also look to be helpful to VCs. And if we can find a potential investor into a VC fund, we know that we can build a really good relationship with that investor, and we collect a lot of really useful data and a lot of useful intel. And so we can then leverage those relationships to benefit founders. For founders that we don't work with, and we probably speak to about 100 a month and pick a couple to actually engage formally. The other 98, what we do is we provide a lot of templates for them, and a lot of, there's lists that you have. We publish a list on our websites of investors, and that list syncs to the data we have and we collect directly from them. And so I think my advice would be to look at those different lists on the internet, put in your top 100, and then separate that into different buckets based on sector and based on geography and based on ticket size. And then, of course, look out for and identify warm introductions, or increasingly, especially in Europe, investors are becoming much more open to cold emails, and you can check that quite easily. You can go on their website, and if they've got a contact us page and all the founders saying this is, these are our details, and of course they're open to emails. Other investors, if you go on their website, they'll say we only accept warm intros only. So it's clear from your research that you can actually identify who might be relevant. And of course, and the last tip is to look for similar companies. So if an investor's made an investment in a similar company, that's the best source of evidence that A, they're active, and B, it's relevant to your own organization.
Yep. I echo all of that. What two-part question? These are unrelated questions, but I'm going to ask it as a two-part question. How many VCs are in UK? Like if you have a broad sense, and then when you're counseling one of your clients, how big should their target list be?
Yes, good question. So, we track all institutional investors in Europe, of which there's around 5,000, and that generally excludes angels and family officers. Who knows, right? There's 1,000 family officers, but who knows how many there are at any one time because they're so discreet. So we track around 5,000 that are based in Europe, and another 5,000 that are based outside Europe that invest in Europe. Out of those 5,000, probably around 900 are UK based. On the institutional side, and all the UK investors we know probably 99% of them, if they're non-UK but investing in UK business, obviously we look to work with them and know them as well. But generally those are the numbers, kind of 4 or 5 in UK and Europe, and about 800 to 900 in the UK. In terms of an ideal investor list, I think the answer there is that you look at you follow the stats that the VCs are giving you. And the VCs are typically telling you that 1 in 100 company they speak to, they invest. You can get rid of 50% of that without too much difficulty, because you can assume that 50% of the companies that inbound they speak to are completely not relevant because of ticket size, geo, or sector. So then the real answer then becomes 1 in 50. So then if 1 in 50 serious company approaches the fund and 1 in 50 gets an investment, if you're aiming for 2-3 term sheets, then clearly the answer is 100 to 150. And that's just based on the logic that the VCs claim around the number of companies that are seriously fit within their thesis. So if you're a good company, you fit the thesis and you've got some good traction and you're at the seed A, B level, 100, 150 is a good target for you to look at.
Yep. I like this. I don't have to argue. I almost want to find more things to argue with you about, but that's what I usually tell founders too, is like 100 to 200 target investors, because like the way I answer that same question is 200 target investors, about a 5% conversion rate. So if you want, X number of investors on the table, you can kind of back into how many you need to talk to. But yeah, 100 to 200.
Exactly.
Yeah.
It's always nice when logic works and you can kind of follow. You can follow it, and you can follow the reasoning. And if you want, as you say, if you want more than a couple of term sheets, obviously it's more. If you want more than investors, obviously it's a lot more. So if you're raising a seed round and you're speaking to angels and you have 10 to 20 angels, then of course the numbers you've got to multiply by 3 or 4 to actually get to the 20.
Yeah, it's interesting. It's from my opinion, it's a numbers game. You've got to talk to a lot of them, but then if you're talking to too many people, you're spraying it too wildly, that's not good either, because you're probably not qualifying and doing the research well enough if you're talking to 500, 800. Like when some of our customers come on and say, I want to load up 2,000 investors in my CRM, like you're not qualified enough. You're not targeted enough if you're doing that, right? So it's kind of this Goldilocks zone. Got to talk to enough, but too many.
Absolutely. And I think the institutional side is slightly different as well, because it's more robust, the process is longer. I think in our experience with a seed round and an angel round, there's a lot more investors you need to target. But with an institutional round, the population is more finite. If you're, to give you an example, if you're a consumer brand that is not tech, so if you produce real things, which sometimes refreshing to work with companies that produce real things, there's 30 to 40 institutional investors max that will invest at the Series A stage. And so your population is finite.
Right.
If you're a tech company, you're B2B SaaS company, there's hundreds. But if you're producing a real thing, there's a certain number. Same thing with life sciences, same thing with hardware, same thing with med tech, same thing with deep tech. If it's very niche and it's not, essentially, if you're not building a B2B SaaS company, your population of investors is finite.
Yeah.
And therefore the conversations become a lot easier.
All right, I want to keep moving because I have a couple more things I want to cover. You guys published a term sheet report. Maybe give us a quick overview of what that means, but what were the interesting findings or discoveries from that?
Yes, so we published it last week. It took us a couple of months to get the information from funds and then about a month to write it. It's the first time 200 investors, so global investors with a small focus on Europe, published and told us about their typical terms. And the typical terms covered, preferences.
How'd you get them to contribute data? Because they're hard to get.
With a lot of difficulty.
Yeah.
We leveraging relationships. Many funds, compete on some of these terms, and there's obviously, I'm sure you've seen in the US, a move towards more transparency.
Yeah, sure.
We partner with Landscape on the report, who are an anonymous VC review website, which helps as well. And it covered, a typical term sheet. Essentially, they shared a typical term sheet via a questionnaire. And we published these results last week. We've had lots of support from founders. It was published in a number of different publications, IFTA, Tech.eu, etc. And essentially, the high-level terms and the high-level information is valuations are on the rise. I think they've doubled to triple or so in the last 10 years. Looking at some of the high-level figures, what a market term sheet is. So from a share preference perspective, it's a 1x non-participating preference. When it comes to deal fees, the majority of investors recharged their legal fees to the company. And on average, the total fees was around 1 to 2% of the investment. When it comes to founder vesting, the average founder vesting required by investors, which is where founders have to give away their shares and claw them back effectively during the cycle, is 4 years on a monthly basis with a 12-month cliff, i.e. nothing for the first 12 months. And over the next 3 years, they get it back every month. Exclusivity was about a month or so when you sign the term sheet. There were no sustainability clauses. Share options was around 5 to 10% of the share option pool. And there were no standard position on whether the pre or post money, whether the option pool gets diluted in the pre or the post. And then there was no equity ratchets or growth shares or guarantees. So that's your typical market standard term sheet. So those are the terms that if you're raising A, B, and C rounds, you expect to receive from investors. And what we find is one of the most contentious terms is founder vesting. And within that, we saw that 98% of the 200 funds asked for founder vesting. So it's still one of the most hotly negotiated and controversial elements in the term sheet, because if I'm a founder, I've just built this business for 4 years, I'm raising investment, and what are you asking me to do? Give away all my shares? I've sweated, tears, blood for 4 years, and now you're saying, for £1 million, £1 million, you wanted me to give away the shares.
Yeah.
It's clearly a very emotional topic, but only 2% of investors don't ask for it. So clearly this is something that when you're raising capital, you need to be absolutely aware of. And of course, the negotiation position is how much percentage of those shares do you give back. So do you say, 50% will be fully vested on day one, i.e. you keep half the shares, and then the other remaining 50% is actually reverse vested over X number of years. And you can find out more information about the term sheet report if you just jump on my LinkedIn and look at the last post I did last week.
Yeah, I'd like to share it on maybe our Facebook group or something too. It looks good. And I haven't gone through it full disclosure. Tell me if this is in there or not, but do you have average equity percent at seed and series A that founders have to give up? Like, in other words, typical seed round founders are giving up 20.
We've got types of fund. What we found is that there wasn't a statistically significant change in different funding rounds. And so we didn't pull too much of the data from that. Based on experience, we see that your pre-seed seed is 10, 15, 20. Your A is 15 to 25, similar to your B. And so generally, if you're raising institutional funding, the medium is around 20%. So if you're raising 2 million and you're giving away 20%, then clearly your post money valuation will be 10 million. And that's kind of the rule of thumb applies in the majority of cases. Of course, there's exceptions, but again, I'm speaking about the median investor.
What you said there, and I'll go through this in more detail, but it sounded pretty as expected. Any surprises from this report? Like, oh wow, we didn't think this would,
I think the surprises was I think there were a number of surprises. And there's some areas that we weren't surprised because obviously we've seen a lot of it, but some areas that other VCs were surprised on was fees. That 1 to 2% was the average charge. Some investors believe that startups should not be paying fees, and those same investors are either family offices or they charge their fees higher up the food chain. So most
fees to either a broker or agent or to the law firm, or what fees?
No. So I guess there's a bit of confusion, right? So this is if I invest $1 million into your business, Nathan, you might not see the full million because there would be legal and deal fees, and therefore you would see maybe $950,000, right. and therefore your net amount will be net of fees.
Gotcha.
And so this is fees that the investor takes from their own investment.
I see.
And the reason why this is often a hot debate is that some investors believe that founders should pay no fees and get the full amount. Notwithstanding all the work that we might do, this is a usual founder, usual investor relationship. Some investors believe there should be no fees at all, and the point is that those investors, they charge their fees from their own investors higher up the food chain. And so of course there's a difference in types of funds. So some funds don't charge their investors higher up the food chain; they charge the startup company. And so this is generally a debate that especially in Europe, especially for smaller fund sizes, right? If a VC is a 20 million fund size, their management fee typically is 2% a year. And for many, with a team of 6, with office space, with salaries, you can't really live off just charging the 2% to your LPs. You've got to have some other fees down at the startup level, and that's where the debate becomes, and which is why a lot of the big brands VCs don't do this, because if you've got $1 billion under management, you're collecting $2 million a year. $2 million is sufficient. Sorry, $20 million. If you've got a 100 million fund, you're collecting $2 million. If you've got a 1 billion fund, you're collecting $20 million. And so you don't need to recharge $50,000 to your startups because you've got $20 million to pay for your entire team.
Yeah.
And so this is one of the debates. The other aspect that was surprising was the fact that 98% of investors wanted founder investing, because it's such it's still an area that many founders just aren't happy with.
Yeah, interesting. All right. Well, won't keep you too much longer. What are some of the favorite nuggets of advice you give founders who are out to go raise capital? And I guess if there's anything particular for either UK founders in particular, or possibly UK or EU founders that are looking to maybe make the jump to Silicon Valley or US, any advice at all? What do you like to share?
Sure. Some of our advice when we have a kind of a short hour, intense hour of fundraising workshops, what do we normally say when it comes to term sheets? One of the golden rules is try not to negotiate before you have a term sheet.
Okay.
A term sheet increases FOMO, increases competitive tensions. Yeah. And as soon as you've got something in writing, it changes the dynamics of the round, because someone is willing to put investment into your company at a certain valuation with certain terms. So one of the rules that we often tell founders, both UK, EU, and the US, is don't negotiate when you've got a term sheet. The second rule is once you've got a term sheet, negotiate as much as you possibly can. Yeah. Because A, VCs want to get you in exclusivity for, we've shown the standard is 1 month, but it can be up to 3 months. We've seen in term sheets. B, your lawyers will have a right good old time reviewing it if there's nothing in it and negotiating all the legals after you've agreed it. And C, you can still build competitive tensions and, speak to other funds and actually get other term sheets you might be happy with. And that is a mistake that many founders make. They get a term sheet, fine, they sign it, and then all the legals come out. What's the warranty cap? What are the investor consents? I didn't know I had to ask you to hire someone with, had to paying them more than 100K. I didn't know I had to ask your permission to take a bank loan out of 10K. All these investor consents, you want to put them in the term sheet. And so that's our second, tip that often we give founders is always negotiate after you've received it. And then the third one is do your prep before you go out to market, because there's nothing worse than an investor asking on day one, Nathan, please send me your financial model, and you reply within 2 weeks. What does that suggest? You're not speaking to anyone, you haven't got your ducks in order, and ultimately your credibility just shoots downhill. So do your prep before you go out to fundraise, which is, I know, easier said than done, because often people want to go out yesterday, but actually the benefit you get from prep is significant.
Yeah, and I think, and you wonder, why do people not prep before? I think sometimes people get pulled into fundraising. Maybe some investor reaches out, starts to engage with them in a discussion, and they're not really ready to raise money, so they're kind of pulled into raising. Actually, but before we go anywhere further, I want to talk about exclusivity for a minute and term sheets. So, this is something I think is tricky or opaque to many founders. Like, if you get a term sheet, once you sign it, you're in a period of exclusivity with that investor where you're negotiating. But before you sign it, do you recommend using that first term sheet to go kind of collect other term sheets, or using that to drum up other interest? Or maybe talk about that unique little window.
Yeah, so I think there's a dynamic. So we would not expect, it's not good practice to send the term sheet to other investors. So we recommend not using that term sheet as a flag and sending and forwarding it on to all your investors. What we do recommend doing, however, is if you're in discussion with a number of investors, dropping them a note and saying, we've got a term sheet, we're looking to sign in the next week. The high level terms are, we're looking to raise, 3 million at a 15 mil valuation, and we're looking to move fast. Can you, we'll accept final offers by X date. Let me know if you're still interested and jump on a call with them. That is a perfectly acceptable thing to do with all the investors you're currently speaking to. Once you sign exclusivity, of course, if you've got a lead and looking for co-investors, you need to be very careful that you opt out of the exclusivity for finding other leads, because you don't want to go back to your lead investor and go, by the way, can I speak to this potential co-investor? And you don't want to have permission for each ongoing conversation you have outside the process. So that's something to think about when you've got a lead looking, you haven't got the full rounds with this particular investor.
Let me clarify that. When you're saying, when you have a term sheet from a lead investor, but it's not the full round, it's half the round. You're saying there should not be exclusivity for talking to other investors to fill the round. Is that?
Exactly. And it's not so much exclusivity, because most investors, of course, will not ask for exclusivity. There's sometimes a clause in there which says, check in on us with us before you approach new funds. So you want to, the protection the investor wants from exclusivity is you don't find another lead, not that you don't find other co-investors. So there's a little bit of clarification often with that clause. But investors are incentivized to get you to sign exclusivity as soon as possible. Why? Because they can take their time and they can diligence you. You're incentivized to push exclusivity as far as possible down the window of fundraising after you've negotiated as much as you can on the term sheet, because that's the founder's responsibility. As soon as you sign it, that's it. And some investors have abort fees, have abort percentages, and there's all sorts of things in there that they can disincentivize you from speaking to others.
You recommend, once you get that first term sheet, but before you've signed it and starting an exclusivity, do you recommend kind of stretching out that period? Like, I need 2 weeks to kind of talk to some of the other investors we're talking to and seeing who else, like, you have that sort of sweet momentum at that point before getting into exclusivity, that I feel is a pretty key point in time for a startup.
Absolutely.
Right? Yeah.
And my second golden rule is negotiate as much as you can after you've received it. And of course, the benefit of that is not only are you saving yourself legal fees on the back end, but you're putting all this information up front in the term sheet so there's no surprises, which allows you to speak to other investors. And so it's like a double benefit. You're saving yourself in the future, but you're also allowing yourself to speak to others. And therefore, it's not that you're saying, investor, give me 2 weeks to chase other investors. It's investor, let's discuss all the detail that typically comes up and spend, the lawyers on the other side will spend 2 months saying, no, we agreed this good leaver definition. No, we agreed this bad leaver definition. No, of course there was founder vesting. Well, there wasn't any founder vesting on the term sheet. Why did he bring it up in the legals? And so all of that stuff, the benefit to you and to the fund is to get all that stuff early, which gives you the energy and the time to speak to other funds. And so they come hand in hand. And so it's not a case of, give us 2 weeks to find better terms. It's let's get to terms now that are sensible and you negotiate in good faith.
Yeah, interesting. All right. I know we're almost out of time, but last question. If you say exclusivity and let's say it's a month and then the deal doesn't conclude in that month, does that kill the deal in your experience? Like if you have to, wait till the exclusivity is over and then kind of go and try and find a different lead for whatever reason you couldn't come to fruition, does that often kill deals? Do you know what I'm asking?
And we've never seen it kill a deal, and there's always a sensible reason behind it. So DD is taking longer than expected. There's one client we're working with at the moment where they haven't signed, the deal hasn't completed, and that's purely because they need FCA regulation. And so it's just taking a bit more time. The FCA, obviously a slow regulatory body in the UK, and it's taking more time. And so if there's a sensible explanation, then no. The investor will typically want to renegotiate exclusivity, though, to make sure that all the work they've done isn't for nothing. But there's no reason why it should kill a deal now.
Yeah, interesting stuff. All right, I could ask you 1,000 more questions, but I will let you get back to business here. If people want to learn more, it's Mountside Ventures, MountSideVentures.com, or follow me on LinkedIn to check out that term sheet guide. Anything else you want to kind of mention or plug here?
No, always open to speak to any founders looking to raise from Europe, and we produce a lot of resources on our website. So don't hesitate to check them out and reach out if you want some help.
Do you get any U.S. companies trying to come to UK for any reason, or is it kind of
lots of US companies looking to open offices in Europe? Yeah, definitely. There's a big trend, and it's always it's both US companies coming to Europe and European companies coming to the US. In fact, one of our clients recently has just raised a couple of months ago is going to the US next week to start the US office out there, which is great.
It's exciting. All right, Jonathan, this has been great. Lots of interesting stuff here. Cool. Well, thank you so much. Good luck. And maybe we'll have a part 2 to this because I have more questions. But anyway, we'll have a part 2 in a couple months.
No problem. It's been a lot of fun. Thanks, Nathan.
All right. Cheers.